As of Tuesday's close, the S&P 500 is down more than 15% since the start of the year. But could this pave the way for an even bigger downturn in the months ahead? Let's take a look at what the data says. This is a spreadsheet I created in Google Sheets to track historical S&P 500 returns by month, by year, and also I've highlighted the first quarter returns. So for 2025, as of the end of the first quarter, the S&P 500 was down 4.6%. Now, obviously, it's down year to date even more than that, but this is as of March 31st. And I wanted to compare the first quarter to previous years to see, does a bad first quarter mean that the stock market's doomed for a bad year? So let's take a look at the last time this has happened. And that was back in 2022. And that year, the S&P 500 fell more than 19%. So it was a really bad year for the markets. Afterwards, however, they ended up recovering thanks in large part to AI and ChatGPT and all that hype and excitement around that. Prior to that was 2020, the COVID crash. The S&P 500 was down around 20% through the first 3 months of that year as there were shutdowns and a lot of concerns about the pandemic. Now, ultimately, government stimulus helped lift stocks and consumer spending. And by the end of the year, the S&P 500 ended up in positive territory, well up and around 17%. So after that first quarter, it ended up rallying more than 45% by the end of the year. That didn't happen back in 2022 when the markets continued to tank after that first quarter. Now, if you go back before that, the last time Q1 was down more than 5% was back in 2009 and 2008. So this was during the Great Recession. So 2009, the Great Recession ended, but the market still started the year badly, down 12%. That's how far the S&P fell in the first 3 months of the year. It ended up finishing in positive territory, however, up more than 23%. And as you can see here in this column, the S&P 500 actually ended up rallying almost 40% after March. So it had a very good performance afterwards, and that resembles that rally, that pickup after the end of the recession. People were feeling more bullish about the economy, and so stocks rallied. But back in 2008, when the Great Recession was still in its early stages, stocks were actually down just 10% in the S&P, but the annual return was a negative 38%, and stocks would actually proceed to fall even further after March, down more than 30%. So in 2008, you had the start of the Great Recession, so it was a bad year. 2009, the tail end of it, was a much better performance. Now, prior to that, the last time going back to 2001, that was the last time in my data sample here going back to 1997. 2001 was the last time there was a big first quarter drop in the S&P 500 when the market was down 12%. That was towards the tail end of the dot-com bubble. That year, the S&P ended up falling more than 13%, so it still continued to decline about another 1%, but overall it wasn't a massive sell-off afterwards. And that was, again, towards the tail end, I believe, around the dot-com bubble. It had already started at that point to crash, so that may have played a part of it. But as you can see, in 2002, actually, the S&P 500 did have a worse year. So overall, what we can see from this is that, for the most part, a bad quarter to start usually does mean a bad performance for the year. The exceptions being the end of the Great Recession and the COVID pandemic, where government stimulus helped sort of rescue the stocks and an overall economy. But outside of that, you look at 2022, there was a big drop afterwards. You look at the start of the Great Recession, big drop afterwards. You look at 2001, still a bit of a modest drop, but it didn't end up recovering. So overall, in most cases, you can expect to see a big drop in the markets overall if there's a bad year. The question is, how bad will it be? Will it be just a modest 1% drop for the rest of the year? Or could this be the start of something much worse, like the Great Recession? Are we in the early stages of that? And obviously a lot's going to depend on tariffs and what President Trump does with that and how long they're in effect, and also how severe they are. Obviously, things with China and the U.S. are looking pretty bad right now, so that could weigh heavily on a lot of big stocks, including Apple, Nvidia, a lot of companies that rely on getting imports from China. So that's the big wild card right now, is what happens with tariffs. If Trump pauses tariffs or comes to agreements with these countries, then you can see a reversal, just like in 2020, where stocks begin to rally and investor sentiment improves. Or on the flip side, the start of a much prolonged, significant recession, just like in the Great Recession in 2008, and we could be facing a much steeper decline in the markets to come. So it really depends a lot on how that's going to play out. But overall, this is a fairly bad sign just because it doesn't happen often, and when it does, usually there's some big concerns in the markets with respect to how the economy is going. So now may be a good time to potentially pivot, maybe out of the market, maybe into dividend stocks, maybe into ETFs, but growth stocks, especially tech stocks, could be particularly vulnerable right now, especially those that are heavily dependent on imports from Asia and specifically China. So it could be a bit of a dangerous time to be holding stocks. So now might be a good time to look at which ones are overpriced and potentially move into safer stocks, dividend stocks, utility stocks, those types of investments that may be more resilient. But overall, it looks to be like 2025 is shaping up to be a pretty bad year for the markets.